Welcome back to Harlem Stories, and in this episode, we're going to talk about different types of lending in Manhattan compared to other places. So, you want to explain a little bit how lending differs here in New York City, or specifically in Manhattan, compared to other parts of New York?
Sure. In Manhattan, we do what's mostly known as portfolio lending. Now, there's going to be some properties that fit the same qualifications and aspects that you find in the rest of the country, but that's not the norm here. Is it possible you can find an easy loan go to any internet site and look it up and get a rate that's close to what they promise? Yeah, it is possible. But that said, the vast majority of lending here doesn't conform to the national standards. So you have these large agencies that are government-backed, such as Fannie Mae and Freddie Mac and some that are state-based. I forget the name. I think it's Sony Mae is New York, state of New York, Sony. And these are lenders that are fairly generic, and they have underwriting standards that are fairly, tailored to the way the rest of the country works. But in New York City, it runs very differently. So a good example is in trying to underwrite in co-ops. So co-ops are not going to meet Fannie and Freddie Mae requirements, and therefore is not easily lendable. Now, why don't they? Why aren't they easily underwritable? Well, because you're not buying real property. You're buying shares in a corporation. And Fannie Mae and Freddie Mac and all the other agencies, they were never created to address that kind of issue. So right then and there, that kind of takes you out of the norms, and they won't underwrite in those kind of situations.
So let me ask a question. So we let's say I go online, and then there's an offer for someone who lives in New York State for Rocket Mortgage. Can I just go ahead and apply for a loan from them?
So the answer to them will be, or at least one of the questions I have for them, and I know Rocket Mortgage is great for a lot of people, and this is not, anything against Rocket Mortgage or anything like that, but I know that at least a year or two I looked back on the Rocket Mortgage website, and it was really geared. They did not do what's known as portfolio lending. They did these vanilla loans, which doesn't really apply as much in New York. So I think if you were to, go with Rocket Mortgage, you'd want to actually speak to somebody over there and not just do their internet application, because in most cases, if you told them and said, listen, I'm buying a co-op, or, my broker is telling me that the vast majority of lending in Manhattan is not agency lending, but portfolio lending. Does it make sense for me to apply to a mortgage there? And, and my expectation is the good people over at Rocket Mortgage will probably say, well, we don't underwrite co-ops. And as far as if you were to purchase a condo, it makes a little bit more sense for us to discuss and make sure that actually meets the right qualifications.
So what if I, not to pick on Rocket Mortgage, let's say if I go to my bank, let's say if I'm banking at Wells Fargo, right, and I decide to apply for a home loan, how would that work? Would they be able to give me a loan as well?
So the answer to that is again, it's not as simple or black and white as what you would expect in the rest of the nation. The rest of the nation, you're expecting the vast majority of the properties, and I think if you're to look at the percentages, I think it comes out to be something like 95% of mortgages that are underwritten do qualify for the underwriting standards of Fannie Mae or Freddie Mac. Those two agencies alone.
95% of all loans that are underwritten will conform to Fannie Mae or Freddie Mac.
That's correct. So as a result, those are, there's pretty standard, application. So if you go to Wells Fargo and let's say you're not a Manhattan resident, you're not a New York City resident, let's say you live upstate or anywhere else in the country, and you tell them you're thinking about buying in Manhattan, they'll probably initially say, sure, no problem. We'll look at your personal situation and we'll make some decisions, based off of that. However, a lot of it will really depend on their experience in understanding the Manhattan market and how it differs, and understanding that most properties in Manhattan don't necessarily qualify for these agencies, for lending and underwriting.
Okay, so do you mind explaining a little bit more about portfolio lending or what a portfolio loan is?
Yeah, so lending or portfolio underwriting is when the bank is not necessarily looking to sell that loan to these agencies and have it packaged and securitized in the financial markets. So in essence, they are planning to underwrite this loan and hold on to it themselves, which means they're undertaking that risk themselves if you don't pay. So, as opposed to if it goes into the agency and securitization process, it goes and gets bundled as part of a larger portfolio, and the risk is greatly reduced, on any one borrower, defaulting on that mortgage. Whereas, the bank is undertaking that risk themselves in a portfolio lending situation.
Okay, and can you explain for people who might not really understand what it means when you say underwriting? What is underwriting?
So underwriting is what happens when you're actually being underwritten to, and they're actually writing all these processes out. We're in today's world more typing it out, but they're actually making the determination whether they should lend to you or not.
So it's basically analyzing whether or not the loan or the money will be lent.
Yeah. Now, what makes Manhattan, so very different is they're actually, doing a much deeper analysis, not just on you. Remember, in lending in much of the country, they're lending mostly based on you. And while there's going to be some situations where they might be looking, taking a deeper look into the property, like for instance, if it were in a flood zone in the country, they might be looking at that whether they want to underwrite. But the vast majority of times, if it's just a generic home, no red flags or anything like that, they're primarily really approving on you. Whereas in Manhattan, it's two sets of approvals. One, that they're looking to approve you, and two, they're looking to approve the building and make sure that it whatever standards it meets, that they're comfortable underwriting it and lending that money to the borrower.
So we don't know what these standards are. These are obviously what the bank determines as their criteria for whether or not they want to underwrite a building.
That's correct. Yeah, every bank is going to have a different requirement, and they're going to look at each building individually when you're talking about portfolio lending. So it might be, in essence, like a one-off approval type of situation, and they have to be comfortable with that. And there are aspects over here that we're hearing that, especially with the change in laws and Fannie Mae and Freddie Mac, especially with regard to Surfside collapse in Miami, where that building collapsed, they're going to have, I kind of expect that there's going to be some changes in underwriting standards going forward. We're already familiar with one of those changes where the banks are actually now looking for reserve studies. And, that is an expensive and time-consuming process. And given how expensive Manhattan is in the first place, a lot of buildings will push back on, the cost and time and effort that it takes to go through a reserve study. So a lot of times they're not necessarily doing it. Will that behavior change? Maybe, maybe not. But I can tell you the environment here is definitely different. We have on our books, these 5-year requirements by our Department of Buildings, where our facade is required to be inspected by engineers professionally, and the engineers are, basically, requiring if that there's problems, that the problems be resolved in a certain, very quantifiable period of time. And it'll differ depending on the situation. But ultimately, that's what really makes us different from like a Miami type of situation where, there wasn't a requirement to inspect the building the way that it is in New York City, where we have every 5 years. They had like one inspection every 40 years.
Okay, so portfolio lending, just to reiterate, has to do with the bank itself taking on the risk of a loan versus other parts of the country. I guess it's underwritten by Fannie Mae or Freddie Mac, I guess is the term, to be able to reduce the risk because you're able to bundle up these loans into securities, right, and then
Correct.
resell them.
Mortgage-backed
Right.
securities.
But if you are a portfolio lender, what you're doing is you're actually taking that risk on yourself. So you are much more rigorous, I would imagine, on two things. Number one, it would be the wherewithal of the person who's actually, you're giving the loan to. So what's their income? How long have they been doing their job, et cetera, their employment history, their credit score, credit rating. And the other factor at the same time is how risky is that building that we're lending the borrower is going to be living in, right? So like Surfside, is there a chance that the building something could happen to the building, right? So that's where you were talking about reserve studies, because I guess a reserve study has to do with how much money would be needed to maintain in reserve in order to handle anything that could possibly come up. And that would be, again, that's probably really, really detail-oriented and would take some time to do properly, correct?
Yeah, and the other component to that in terms of like the building requirements, like one big determinant is what happens if this is a conversion building, for instance. And a lot of these conversion buildings, you might have the original sponsor or landlord, in essence, that's converting the unit one by one into condos. And a lot of times, the generic agency lending, they don't really want to see a high percentage of, one owner. And in fact, I don't know what the current percentages are, but I know in the past that they needed to be under, I think it was 12% or something like that. In New York City, it's not unusual to have the sponsor, still own a number of unsold shares because they have rent-controlled or rent-stabilized tenants, still in the building. So they might have to hold on to those tenants for a really long time before they can wind up converting them to condo. And a lot of times, that is justification alone for these buildings not to fall under Fannie Mae or agency type of lending situations. There's one, particular group, of sponsor buildings that I work with quite a bit, and as a result, the sponsor, most of these buildings are less than half sold, or just over the halfway point, and as a result, there aren't a whole lot of banks that want to lend in these kind of situations. So going back to the initial situation, and it goes back to there's two levels of approvals that need to happen. The bank needs to approve both the borrower and they need to approve the building, because a lot of those kind of situations, they're not necessarily going to meet the reserve study requirement from Fannie Mae or Freddie Mac. They're not going to, have a low enough percentage of non-sponsor or, individual, owned units by one individual. So a lot of times they have too many units owned by one entity, and a lot of times that's just enough to disqualify the building out of the traditional agency lending route.
Okay, so then I'm just going to kind of sort of understand why it doesn't conform, or what the problem is with not conforming to the agency loan, and that is only because I would imagine that it would be perceived as risky for a loan to be made to a building that has, one owner that controls a large portion of the building.
Yeah, and while these are a couple of the points that I brought up, with the the reserve study and the sponsor owning too many units, these are just a couple of the key points that tend to come up that we as agents tend to see. I'm sure that bankers probably see some other, finer details that where it doesn't necessarily meet Fannie or Freddie or any of the other agency lending requirements as well. But at least these are a couple key points to be aware of. And obviously, a good banker that understands portfolio lending, will be familiar with all these different aspects. This is actually a key reason why, as agents, we're always pushing you to use, Manhattan-based lenders. Now, not to say that somebody outside of Manhattan can't get the job done, but the odds obviously make it all that much more difficult if they're not aware of these key points and even some of the aspects that we as agents don't know about.
Great. All right. Well, thank you very much. And thank you for joining us. And we'll be back again with another episode of Harlem Stories.